the 5 financial metrics that will save your new business from failure. Let me tell you about the worst meeting I ever had as a consultant. I was sitting across from a business owner in Ontario. He ran a marketing agency, 3 years old, growing fast, great clients, talented team. He called me because he was about to lose everything. "I don't understand," he said. "We're billing more than ever. We just signed our biggest client. How am I about to run out of money?" I asked him one simple question. "What was your cash position 7 days ago?" He stared at me. He had no idea. I asked another, "What's your average collection time on invoices?" Blank stare. "What's your current burn rate?" Nothing. He was running a $400,000 business by looking at his bank balance once a month and hoping for the best. 3 weeks later, he couldn't make payroll. His business barely survived. This happens every single day to new business owners across Canada, and it's completely preventable. Let's get started. Hey there, I'm Scott Lindsay. Welcome to the Small Business Risk Channel. I'm a former Chief Risk Officer, CFO, and entrepreneur who's helped organizations manage billions in risk. I've also built and grown my own successful business from scratch. If you're about to launch or you just started your business, do me a favor right now. Hit that subscribe button and click the notification bell. I release a new video every single week with strategies that can save you thousands of dollars and months of mistakes. And if you find this video valuable, smash that like button. It helps more entrepreneurs find this information. I'm going to show you the 5 financial metrics you must track weekly in your new business. Not monthly, not quarterly, weekly. These 5 numbers will tell you if you're headed for success or disaster, and they'll tell you in time to actually do something about it. I've spent 20 years helping Canadian business owners implement financial tracking systems. I've seen businesses saved because they watched these numbers, and I've seen businesses fail because they didn't. Let's make sure you're in the first group. Metric number 1, cash position. This is the most important number in your business, period. Cash position is simple. How much actual money do you have available right now? Not accounts receivable, not money people owe you. Actual cash in your bank account that you can spend today. Let me tell you about a consulting firm in Saskatoon I worked with last year. On paper, they were profitable. They had $80,000 in outstanding invoices. Their financial statements looked great, but they had $4,000 in the bank, and payroll was $12,000, due in 6 days. The owner, a brilliant consultant, told me, "But we're owed so much money. We're fine." No, they weren't fine. They were 6 days from collapse. Here's what most new business owners don't understand. You cannot pay employees with invoices. You cannot pay rent with receivables. You cannot buy supplies with promises. You pay with cash, and if you don't have it, you're done. I helped them implement a simple weekly cash tracking system. Every Monday morning, they knew their exact cash position. They knew what was coming in that week. They knew what was going out. Within 3 months, they maintained a minimum cash buffer of $30,000. They never scrambled again. Here's how you track this weekly. Open a spreadsheet. Every Monday, record your current bank balance. Record any deposits expected this week. Record any payments due this week. Calculate your projected end-of-week cash position. If that number is trending down week over week, you have a problem. You need to either collect faster, reduce expenses, or bring in more revenue. The earlier you see the trend, the more options you have. I've created cash position tracking templates for businesses at every revenue level. Simple spreadsheets that take 5 minutes a week to update. If you're not tracking your cash position weekly, you're flying blind. Drop a comment below and tell me, do you know your exact cash position right now this minute? If the answer is no, we need to fix that. Metric number 2, burn rate. Your burn rate is how much cash you're spending every month to keep the business running. This includes everything: salaries, rent, software subscriptions, insurance, utilities, supplies, everything that goes out the door. A software startup in Waterloo came to me 18 months ago. They just raised $200,000 in angel funding. They were thrilled. "We're set for at least 2 years, the founder told me. I asked him his monthly burn rate. He estimated around $8,000 a month. We did the math together. His actual burn rate was $14,000 a month. At that rate, his $200,000 would last 14 months, not 24. He'd be out of money before his product was fully built, before he could generate meaningful revenue, before he could raise the next round. The red flag he missed: he didn't track burn rate weekly, so he didn't notice when it started creeping up. Here's what happened. They hired a developer, added office space, upgraded their software tools. Each decision seemed small, but collectively they increased burn rate by 75%. By the time he called me, he had 8 months of runway left and a product that needed 12 months to launch. We cut burn rate to $9,000 a month, renegotiated the office lease, switched to cheaper software tools, delayed one hire. They made it, barely, but it was terrifying. Here's how to track burn rate weekly. Add up all your fixed expenses for the month, add your average variable expenses, divide by 4.3 to get your weekly burn rate. Every week, track your actual spending against this number. If you're consistently over, you're burning faster than planned, you need to adjust immediately. New businesses fail because they run out of money before they figure out how to make money. Burn rate tells you how much time you have. I can provide you with burn rate tracking templates or work with you to build a custom financial dashboard that shows burn rate in real time. Questions about calculating or reducing your burn rate? Drop them in the comments. I'll answer every single one. Metric number 3, Runway. Runway is simple math. How many weeks or months can you survive at your current burn rate before you run out of cash? It's your cash position divided by your burn rate. A retail store in Victoria opened 2 years ago. The owner invested $50,000 of her own money. She thought she was well capitalized. Her burn rate was $12,000 a month. That gave her 4 months of runway. She assumed she'd be profitable by month 3. She wasn't. By month 4, she was scrambling for a line of credit. She got it, but at terrible terms. 18% interest. It cost her thousands in unnecessary interest payments. The red flag. She never calculated runway. She just assumed she had enough. If she'd been tracking runway weekly, she would have seen it dropping. She could have reduced burn rate earlier, or she could have secured better financing before she was desperate. Banks give better terms to businesses that plan ahead than to businesses that are panicking. Here's how to track runway weekly. Take your current cash position. Divide by your monthly burn rate. That's your runway in months. Multiply by 4.3 to get runway in weeks. If your runway drops below 12 weeks, you're in the danger zone. You need to take immediate action, cut costs, accelerate revenue, or secure financing. Most new businesses need at least 12 months of runway. 18 months is better. 24 months is ideal. Every week, you should see your runway number. You should watch it like a pilot watches altitude. If it's dropping, you're heading for a crash. Adjust before you run out of options. I've helped dozens of Canadian startups build runway tracking systems that integrate with their existing bookkeeping. It's not complicated, but it's essential. Concerned about your runway? Tell me in the comments what your current runway is. I'll give you specific advice on whether you need to take action. Metric number 4, accounts receivable aging. This tells you how long it's taking clients to pay you, and it's often where cash flow problems hide. A graphic design firm in Halifax had this problem. They were busy, lots of clients, lots of projects, but they were always short on cash. When I looked at their books, I found the problem. Their average collection time was 73 days. They were essentially providing interest-free loans to every client for 2.5 months. The owner said, "But they all pay eventually. Eventually doesn't pay payroll. Eventually doesn't cover rent." Here's what we discovered. They had no system for following up on overdue invoices. They'd send an invoice and just wait. Sometimes clients paid in 30 days, sometimes 60, sometimes 90. The cash flow was completely unpredictable. We implemented a weekly AR aging review. Every Monday, they looked at every invoice over 30 days old. They called clients, they sent reminders, they negotiated payment plans for large invoices. Average collection time dropped to 38 days. Cash flow became predictable. They could plan. Here's how to track AR aging weekly. Run a report showing all outstanding invoices grouped by age, 0 to 30 days, 31 to 60 days, 61 to 90 days, over 90 days. Calculate what percentage of your total receivables is in each bucket. If more than 20% of your receivables are over 60 days old, you have a collection problem. Every week you should review invoices over 30 days and take action. Call the client, send a reminder, escalate if necessary. The longer an invoice sits unpaid, the less likely you are to collect it. Invoices over 90 days old have a collection rate under 50%. Don't wait. Follow up weekly. I've developed AR management processes for service businesses, product businesses, and hybrid models. The specific approach varies, but the principle is the same. Track weekly, follow up systematically. Struggling with collections? Drop your questions in the comments. I'll help you build a system that works. Metric number 5, revenue run rate and growth trend. This is your current revenue trajectory. Where are you headed if current trends continue? A consulting business in Calgary tracked their monthly revenue. They were hitting their targets. Everything looked fine, but they weren't tracking the trend. Here's what I discovered when I looked at their numbers week by week. Revenue was declining slowly. 3% drop one week, 2% the next, another 4% the week after. On a monthly basis, it looked okay, but the weekly trend showed a business in decline. By the time they noticed the monthly dip, they'd lost 2 major clients and were 3 months behind on addressing the problem. If they'd been watching weekly revenue, they would have seen the trend immediately. They could have investigated. They could have called clients. They could have ramped up sales efforts. Instead, they reacted too late. Here's how to track revenue run rate weekly. Add up all revenue for the current week. Multiply by 52 to get your annual run rate based on this week's performance. Compare to last week's run rate. Is it up or down? Track the trend over 8 to 12 weeks. Are you growing, flat, or declining? If you're declining for 3 consecutive weeks, investigate immediately. What changed? Did you lose a client? Is sales pipeline slowing? Is there a seasonal pattern you didn't expect? The beauty of weekly tracking is early warning. You see problems when they're small and fixable. Monthly tracking shows you problems when they're big and expensive. For new businesses, weekly revenue tracking is essential because trends emerge fast. You don't have years of data to smooth out the noise. Every week matters. I can help you set up revenue tracking dashboards that show not just the numbers, but the trends, visual graphs that make patterns obvious. Questions about tracking revenue or interpreting trends? Ask me in the comments. Now here's the hard truth about these 5 metrics. Tracking them weekly sounds like a lot of work. It's not. It takes 15 minutes every Monday morning. But most new business owners don't do it. They check their bank balance occasionally, they look at monthly statements, they hope for the best, and they get blindsided when things go wrong. The businesses that survive are the ones that know their numbers, weekly, religiously, without fail. Let me show you what weekly financial tracking looks like in practice. Every Monday morning, 9 a.m., you spend 15 minutes, that's it. Open your spreadsheet or financial dashboard. Record your current cash position, update your burn rate if anything changed, calculate your runway, review your AR aging report and note any invoices to follow up on. Record last week's revenue and calculate your run rate. 15 minutes, you now know exactly where your business stands financially. You know if you have a problem. You know what the problem is. You know how much time you have to fix it. This is how you avoid the desperate phone call to a consultant because you can't make payroll. This is how you build a sustainable business instead of a stressful gamble. Here's what I want you to do right now. First, assess your current situation. Do you know these 5 numbers for your business right now? If you can't answer yes to all 5, you have work to do. Second, set up your tracking system this week. Not next month, this week. I've created simple templates for tracking all 5 metrics, spreadsheet-based, easy to use, specifically designed for Canadian small businesses. Or if you need something more sophisticated, I work with business owners to develop bespoke financial dashboards that pull data automatically from your accounting software and present it visually. Either way, the goal is the same. You need to see these 5 numbers every single week. Third, block Monday mornings on your calendar, 9 a.m. to 9:15 a.m. Financial review, non-negotiable. Make this a sacred ritual. Your business depends on it. I've worked with hundreds of business owners over 20 years. The ones who succeed all do the same thing. They know their numbers. They track cash position, burn rate, runway, AR aging, and revenue trends. They do it weekly. They make decisions based on data, not hope. The ones who fail, they ignore the numbers. They make excuses. They say, I'm too busy, or I'm not good with numbers, or I'll get to it next month. And then they run out of money and can't figure out why. Don't be that person. Your business is too important. You've invested too much. You've worked too hard. 15 minutes a week, 5 numbers. That's all it takes to know if you're succeeding or failing. Here's my commitment to you. I will answer every single question you post in the comments. Tell me which of these 5 metrics you're not currently tracking. Ask me how to set up your tracking system. Challenge me on whether weekly tracking is really necessary. I'm here to help. I've built financial tracking systems for restaurants, retail stores, professional services, tech startups, trade businesses, and everything in between. I can provide you with templates you can implement yourself, or I can work with you to create custom solutions for your specific business model and industry. The expertise is here. The tools are available. All you need to do is decide that your business deserves proper financial management. Subscribe to Small Business Risk for weekly content on protecting your business and making smarter financial decisions. Hit the bell so you never miss a video. Drop your questions in the comments right now. Which metric scares you the most? Which one are you ignoring? What's keeping you from tracking your numbers weekly? I'll answer every question. That's my promise to you. Your business won't fail because of bad luck. It will fail because you didn't see the warning signs in time. These 5 metrics are your early warning system. Use them. Track it, know it, survive it. I'll see you in the comments, and I'll see you in the next video.